Good morning, ladies and gentlemen. Welcome back to Boutiques on Wednesdays, and wonderful to have you all joining us again. In recent months, we've seen some exceptional returns from SA equities and SA bonds or fixed income funds, but a lot of clients asking, what can we expect going forward? How would SA companies fare if we do see an improvement in business confidence? And how does the global rate cuts at the moment impact on bond yields and fixed income funds? This is some of our focus points for this morning with the experts, and it's my absolute privilege to welcome Managing Director and Chief Investment Officer at Cadiz Asset Management, Sydney McKinnon. And Sydney will be followed by our team from Investec Investment Management, Barry Shamley, Fund Manager for the past 25 years, and his colleague, Peter Vogel, Co-Fund Manager at Investec Investment Management for the past 12 years. Gentlemen, good morning. It's a great pleasure to have you with us, and thank you so much for joining our webinar. How are you doing?
Morning, Eugene, and thank you for the opportunity. It's really good being with you this morning. Right.
Sydney, you are first. We're ready for you if you are. Yes.
Okay, happy days. Let me share my presentation and then we can kick off. Just tell me if all's good, if you can see everything.
Not there yet. Coming through. Yes, perfect. Thanks, Sydney.
Okay, fantastic. All right, let's not take up any of my colleagues' time. So let me jump right in. And as I said, good morning to everybody that's on the call. Really appreciate it. I'm here to speak about fixed income, Eugene, as you said. Thanks for that. And I promise I will. But I thought, let me entitle my presentation something a little different, and I'm calling it Pluralistic Ignorance and Death Spiral. So let me explain what I'm talking about before I get into the issues. But really, what I want to do today is look at some of the factors that are influencing our interest rate environment at the moment. And as you said earlier on, Eugene, there's quite a bit happening in terms of our interest rate cycle, both globally as well as locally. But there's this phenomenon where pluralistic ignorance occurs when people mistakenly believe that everyone else holds a different opinion from their own. So let me just explain that for a second. And I think the best example is if you are awakened in the middle of the night by what you think is a gunshot, and you wake up and you think, that must be a gunshot, man. Do I call the police? And you think again, and you think, well, I'm sure one of the neighbors must have heard that gunshot as well. And effectively what happens eventually, and I'm sure you say to yourself, well, one of the neighbors will call the police. And what happens is all the neighbors are thinking the same thing, and nobody calls the police. And it kind of made me thought this is kind of the environment that we are in at the moment. Everybody's poised to do something, but we're not quite sure what to do. And there's quite a few of these gunshots that have gone off, and how do we actually act on it? So just from a global perspective, I think one of the important things to look at when influencing interest rates, or what influences interest rates, is global growth, or growth on a global scale. And the soothsayers out there are saying that the global economy is in a sticky spot. And I was looking at some of the numbers from the IMF earlier this year, and it does appear as if there's quite a bit of disparity between the growth that is happening and the growth projections that are out there as well. It appears as if the developed economies are predicting lower growth than, for example, your emerging market your developed economies are projecting low growth than your emerging and developing economies. So, and there seems to be disparity. I mean, we've all seen the latest sort of employment numbers, and I'll maybe speak about that in a second from the States. And at first, there was a lot of thought about the slowdown and whether we're going to have a hard landing or a soft landing, and how much activity there is globally. But the one thing that I think is important, this gunshot that's gone off, is that there's disparity between various economies out there. And it appears as if the growth in major advanced economies is becoming more aligned with each other. So as the output gaps close, but those in the emerging and developing economies seem to be quite diverse in the amount of growth that there is. Originally, the growth slowdown in the US was quite sharper than expected. And everybody was talking about a hard landing, but I think some of the employment numbers we saw recently kind of refuted that to a degree. And then we saw those recessionary fears dissipate, I think, around about July. And we saw a little bit of more activity coming through and the employment data fueling a bit of volatility in markets. And most certainly this, why I mentioned this is because it actually influences the way that interest rates get viewed and how it gets acted upon both by central bankers and by the markets as a whole. I think the other important thing is to look at is obviously inflation, because inflation is embedded within all the yields that we have, especially bond yields such as yield to maturity. And we see the momentum in the global disinflation that seems to be slowing, because we had this quite a bit of momentum, and we've been coming off a high base, and it's been falling towards the targets. But I think one has just got to be careful, because there does appear to be a bit of pressures in the system. And the higher than average inflation in services prices seems to have tempered to some extent. It's somewhat tempered to some extent by stronger disinflation in the prices of goods. So you've got all of these bits and pieces and moving parts in the system. And I mentioned employment, and if we look at things like nominal wage growth, that's been above the inflation rates. And most certainly food price inflation, though, has come down quite sharply. So I think one has got to be quite careful as to how you actually view inflation, even though we are coming off quite a high statistical base. And that I don't think it's just all cool feel-good factor that's happening here. We got to look at the underlying components, and most certainly I think that is going to cause a bit of further volatility in the market. I'm not predicting lots of volatility, but I think that there is room for a bit of volatility, especially as far as yields are concerned. I think that more importantly, and I think this was one of the focal points for today, was monetary policy across the globe. And I think we've seen the ease, and we saw the US cut 50 basis points at its September meeting. So what was felt as a very proactive approach to addressing economic challenges, I think kind of got stymied a little bit when we saw the latest employment numbers coming out. So the big question is, at what pace is the rate cutting going to go forward? And I think recently people were saying, well, there's room for another 50 basis point cut. But now, since the employment numbers came out, I think we're seeing that might not be the case. And obviously this gets filtered through to inflation, to interest rates across the globe as well. So on the one hand, you've got the US that's in that bit of a sticky spot at the moment as far as growth is concerned, as well as the rate cutting cycle. Whereas in Europe, you've got the ECB and the BOE favoring a more gradual approach. Whereas you've seen your emerging market economies are remaining cautious in the way, and we see that reflected in our economy as well, in the way in which our central bank is taking things forward. So monetary policy, I think, is quite crucial at the moment. Even though we're at the top or sort of trending down in the rate cycle, there seems to be a lot of tentativeness in the way in which it's being handled. And this is also being fueled and being fueled by exogenous factors or factors surrounding this, or noise surrounding us, such as the political arena. And I don't think that's the discussion for today, but I think we've got to be cognizant of that. If we move to the global environment, and because of time, I'm moving quite quickly, but I'm sorry, to our local environment, I think we're also going to look at I just want to look at 2 or 3 factors that are influencing our rates at the moment. So our economy is still fairly fragile. Let's not be mistaken about this. And our primary sector is disappointed somewhat in terms of mining and agriculture there. And we know these things are seasonal. But if we see a bit more decisiveness from the global environment, I think we might see a bit of more decisiveness happening on our side. Now, I think the good things or the positive things, I don't know if to mention this all, but we have seen an increase in electricity production and consumption, which is quite positive. Let's keep fingers crossed that the lights remain on. but the consumer is still fairly constrained, and we've got a very high unemployment rate. I don't have to say that more than once. So we've had a bit of an uptick in our business confidence, but I think one has just got to be careful here because it's still below the 50 mark, which means that it's not in territory that's going to influence our growth aspects in a big way. And theoretically, I think this kind of growth environment that we are in locally, even though there's quite a couple of positive green shoots showing out there, it should keep a lid on our yields at the moment. Let me talk briefly about inflation, because as we know, inflation is embedded within yields to maturity, quite important, I think, for us. And as I mentioned early on, from a local perspective, we're also coming off a very high statistical base. So one has got to be careful. We're coming off that high base. We are heading towards, we are within the target bands. We are heading below the midpoint, but that's the base effects that's coming into effect. One thing that I think we've got to be very careful of, even though there has been retracement in core inflation, is fuel prices. We've seen it have a moderating effect initially, but then, of course, there's all kinds of tensions in the Middle East. And who knows, we could be set for a little bit of volatility on oil price, which is very, very likely going forward. I think the international food price environment is going to be quite key. So even though inflation is trending downwards, and it's good for our bond yields in particular, and it will bring down the yields, which will in turn translate into capital appreciation for our bonds. I think one has got to be careful about the fact that you are in an international environment where food prices and supply chains can be disrupted at any point in time. So we just got to be careful about that scenario as well. I cannot continue without looking at one of our other fundamentals that influences the volatility within our interest rate environment locally, and that is our currency. And most certainly, our currency has performed fairly well year to date, especially. I think we've done very, very well, and we saw a bit of weakness in August. I think it was we had a dovish outlook from the SARB. But then, since then, our currency has maintained its shape, even though in the last week or two, we've seen a bit of volatility coming through as well. But I think that was mainly as a result of strength in the dollar, the Middle East tensions causing a bit of safe haven buying through to the dollar, and then we saw our currency depreciate a little bit on the back of that. So we've still got implied volatility in our rand that's quite high, and I think that's quite important because our currency is a very liquid currency. It can be traded virtually anywhere in the world, and currency volatility, even though we are quite strong at the moment, can cause volatility within our interest rate environment. So we've got all these little bits and pieces that's fueling and also influencing the direction in which interest rates will go, and how that eventually influences our bond market. I think my point I'm trying to make it is there's no one single factor. I think everybody's got their hot buttons, and at the moment, I think monetary policy is quite a hot button at the moment and a big influencing factor. But it's not the be-all and it's not the end-all. We got to realize that there's many factors that influence the direction of interest rates. And if we just looked at our local monetary policy and our SARB and the MPC meeting, I think the SARB's tone now is saying that inflation is being projected lower. But in the same breath, they tell us we're quite high relative to the G20 countries. I think at the previous MPC meeting, they were saying the balance of risk is was to the upside as far as inflation is concerned, and now it's balanced. I'm not quite sure what that really means, but it's the terms that they use. I think it's just the kind of risk scale in which they try to influence the way in which things get viewed, and the rhetoric that does get viewed. But I think the US trajectory is quite key. If there's further cuts or aggressive cuts, we'll see that coming through. But most certainly, the point, everything is pointing in the direction of further rate cuts, barring any event risk that might happen, or barring any unforeseen growth spurts or growth that comes through the system. I think we got to just watch that carefully. So the second thing of my presentation that I was talking about, sort of this pluralistic ignorance, we're not quite sure what to do because you don't have the gunshot that's gone off, or whether somebody else is going to call the police or not, is this thing called death spirals. And it's another perplexing financial phenomenon where ants, I'm talking about ants this morning of all things, that essentially they doom themselves by circling endlessly until they die of exhaustion, because they kind of touch each other with the scent and pheromones and whatever the case may be. And it made me think, I think our local environment, we got to be careful of this thing called debt spirals, especially in our credit environment, where we've seen credit spreads narrow to quite a huge or large degree, and the secondary market on the credit market has kind of dried up, and it's not very active, and people are effectively selling their souls for yield and taking on more riskier and riskier assets. And I'm not forecasting or projecting a death spiral in this regard, but I think one has just got to be very cautious about what's happening in terms of the credit spread, because the fixed income environment is quite a large, wide landscape, from your money market fixed deposit type of environment all the way through to bonds and inflation bonds and the like. So and credit, of course, becomes an important component of that as well. So our yield curve is very reflective of what is happening at the moment. And I think we will see lower yields, is my opinion, if there's further rate cuts, and especially from the US, we'll see some flattening of the flattening of the curve. And of course, the declining inflation risk premium, if that continues, will have a very positive effect. And our short end of our yield curve is already projecting that there will be further rate cuts. So why bonds? I mean, this is my area of focus, and maybe I'm a bit biased in saying so, but I do think that there's a big case or a good case for being invested in bonds at the moment. I think we'll see some cuts from National Treasury, and that we'll get some information on that in the medium-term budget policy statement, because I think there is room for issuance cuts at the moment. And what is happening there is that South Africa will post a smaller budget deficit, and therefore they wouldn't need to fund so less supply. More demand will translate into a strong strength within the bond market. And then here and there, we've got improving fiscal metrics, debt to GDP. We all know the story with Trifecta and how things were helped out there. And if the global backdrop remains accommodative, we will also see some positiveness coming through. We've got large buyers in our system. It might not appear that way. We may be saying that foreigners are selling. Yes, but they haven't been selling as much as they have in recent times. And we've got very big pension and unit trust environments locally that supports our bond market, and they've been buyers, and where they have increased their exposure, that may be down weighted their duration, but the reverse is also true. Whenever they've decreased exposure, they've increased duration. So in terms of Cadiz, our outlook on things, we're fairly positive about the market at the moment. This is just a chart showing our level of conviction. So if the histogram or the bar chart is above the zero line, it means we are positive, and in variable B, we will be longer in duration. And all the factors which we look at, which includes economic fundamentals, liquidity valuations, the international environment, as well as the sentiment in the market as well, points towards, collectively and systematically through our investment process, points towards a lower interest rates and a stronger bond market. I think nothing in a straight line. One has just got to take the opportunity when it does arise. So in conclusion, just two of our funds that follows this methodology, that looks at the way in which we align ourselves strategically, is our Enhanced Income Fund. It's a fund that's Reg 28 compliant. It's over 2 billion in size. And it is designed, what I call, for all market conditions, in the sense that it relies on using spreads above JIBAR to attain its objective, and it's a fund with very low variability of returns. So something worth having a look at in terms of being part of your investment basket as a whole. And then our Absolute Yield Fund is a fund that uses a bit more aggression, where we come to things like bonds and volatility, then we can take advantage of in the bond. Also Reg 28 compliant, substantial in size, and very highly competitive relative to his peers. So I would urge anyone that would like to know more to please have a look at it or contact us. We most certainly can give you all the information you need. So Eugene, I think I've gone a minute or two over my time, but that's all that remains for me to say is thank you. And thank you to my colleague, Songa colleague, who put this together for me. Nzakenza, I believe, is thank you in Tsonga. So yeah, let me leave it there. Thanks, Eugene.
Message indeed. If you can start sharing, our Investec investment management team can start to share. And if you can stay on the line, certainly we're possibly going to get some questions afterwards. Barry and Peter, if you are ready, you can start sharing. Barry, I believe you're going to drive the slides. Yeah, I can see you're up. Good stuff.
Thanks, Eugene. Let me just...
Your slides coming through. Yes, on screen, perfect.
Okay, I'm just going to wait. We had this issue earlier with the response. There we go. Okay, excellent. Good morning, Eugene. Good morning, Tanya, Olga, and the BCI team, and of course, everyone that's joined us here this morning. I'm Barry Shamley, joined by Peter Vogel. We manage the Investec BCI Dynamic Equity Fund. And the topic of our presentation this morning is, what if South Africa becomes normal? Before we get started on that topic, I thought a lot of people still confuse us and are not sure where we fit in. We are Investec Investment Management. We fall within the Investec Wealth and Investment International business. We've been around, I like to call us the new old kids on the block. We've been around for a long time, operating purely for Investec Bank and wealth clients. But with the recent unbundling of 91, we're able to offer our services and funds more broadly. We have just under 200 billion of assets under management. Many of our funds have very extensive track records, 15 years plus, and we now have over 25 funds. I'm going to hand over to Peter quickly, who's going to give you a little bit more information now about our particular fund.
Thanks, Barry, and morning all. So this slide is ultimately aimed at giving some insight into our approach to investing. So, i.e., what is it that we're looking for when investing in a company? We are style agnostic, but have a value bias. So we're happy to buy a growth stock, for instance, something like a Stadio, but we don't like to pay up excessively for growth many years into the future. We place a very large weight on quality leadership when investing. Good capital allocators with strong track records and a deep understanding of return on capital. Some of the names that spring to mind would be, Johnny Copeland of HCI, Chris Seabrook of Sabvest, and Andre van der Veen of Novus, and a Phil Roux of Nampak. And what we really like about all of these managers is that they've got significant skin in the game, and they're heavily invested in their respective companies, and their interests are very much aligned with ours. I've already mentioned high and improving return on capital, but again, a strong return on capital, and even better still, if we can pick up a company with an improving return on capital profile that we believe hasn't been picked up or recognized by the market yet, we'd be over the moon with that opportunity, as usually those sorts of companies would result in outsized returns. So while we're not activists per se, we certainly actively engage with companies, particularly where targeted engagement can lead to improved outcomes for our investors. Just on the next slide. So the Investec BCI Dynamic Equity Fund, as Barry mentioned, is an SA-only equity mandate. And within SA equities, we generally have a higher than average exposure to SA Inc. companies. So that would be companies that do particularly well in a positive South African economic environment. And given the fund's relatively high exposure to mid-cap shares. So, this is by no means a small and mid-cap mandate. We invest across the spectrum of the JSE, and we very much benchmark agnostic, which you would pick up by looking at the fund's very high active share, as well as the low correlation with that of most other general equity funds out there, which we'll show on the next slide. But performance has been pretty good over all time periods. We top quartile year to date in 1 year, and over the longer term, 3, 5, 7, and since inception, we actually fit into the top 5% of general equity funds out there. Barry, can you just go to the next slide? So this next slide really just highlights a couple of the positive and differentiating attributes of the fund. On the right, as previously mentioned, it just shows how uncorrelated the returns of the fund are with some of the other larger funds out there, and as well as the market as a whole. We think this is potentially attractive for investors looking to diversify away from, just the top 40 or 50 shares. And it's quite a neat way of gaining exposure to the broader market, as well as gaining some higher exposure to those SA economy players, as we call them. So on the left, we are just trying to illustrate that capital preservation is always at the forefront of our minds. And we have in the past used higher weights in cash to protect the portfolio. So ideally, you want to be in that top left-hand quadrant of this chart, i.e., capturing less of the downside and capturing more of the upside relative to the market. Our track record puts us at capturing around 105%, so it's more than the market's upside when the market's going up, and less than 60% of the market downside, which is obviously something we're quite proud of. I'll hand over to Barry to touch on the next few slides. Thanks.
Thanks, Pete. So over to the topic of our presentation, what if South Africa becomes normal? And what are we talking about? It's economic growth. We've become accustomed to growth rates of around 1% per annum, and we actually celebrate growth rates of 1.5% per annum, but that's not normal. The average growth rate for South Africa from 1994 to 2012 was 3.5%. Median growth across the world is 3.5%. So the question we're asking ourselves is, what if we simply go back to what we were before? Now, we're not saying we're going to go back to 3.5%, but we think there's a reasonably good chance that we're going to grow faster than 1% if the current conditions maintain and persist. So what our chief investment strategist with it is he put together different criteria under different administrations. And what we've done is we've looked at these various administrations and what relationships there were between various data points. And in Nelson Mandela's administration, you could see business confidence in the 40s, industrial metals reasonably strong or growing 6%, GDP at 2.7%, and interest rates were pretty high at that point. Going into Thabo Mbeki's first administration, there we had actually industrial metals weaker. Business confidence was still strong, notably. And that's quite important because you still had employment growth of 2.1%. And that largely was around the fact that rates were dropping over that period. The best of all the periods was Thabo Mbeki's second administration. There we had an SA Inc. working, industrial metals up 144%, business confidence at all-time highs, and GDP growth at 4.8%. Zuma's administration, reasonably strong commodity prices, very weak employment growth. There was money being spent there, but it was going to the wrong places. Inflation was more or less under control, but with that money being spent in the wrong places and business confidence starting to drop, you could see the growth rate slowing down. His second term, that's where the real wheels really fell off. We had a weak global environment, weak industrial metals, business confidence below 40, very lackluster employment growth. And then lastly, moving on to Cyril Ramaphosa's first term, there we had pretty strong industrial metals, but there you could see business confidence in South Africa was shot. And that was after all the years of devastation at the SOEs at Transnet, no end in sight to the load shedding, GDP growth of 0.5% despite strong industrial metals. And they're really as a result of that weak business confidence. Even though we had a positive global environment, unfortunately, because of what was going on the ground, because of the constraints around energy generation, around rail and ports, we just weren't able to grow, and people weren't investors weren't willing to spend and invest, and consumers weren't willing to spend. So what we could see from that was business confidence was key. And what we can see is a strong correlation there between employment growth and business confidence. And what we believe now is with this establishment of this government of national unity, with the fact that the state-owned equities seem to be on a better track, we believe that business confidence is going to start improving, and we'll move to a slide on that just now. But and with that, we'll start seeing some stronger employment growth. And I've seen numbers saying that if we grow anywhere between 2 and 3%, we could get anywhere between 1 million and 2 million jobs over the next couple of years. So business confidence is vital, and it's self-fulfilling. As people get jobs, they start spending money, banks lend more, and growth picks up, and more investment comes into South Africa. The rand strengthens, more bond yields come down, and it's just it's a virtuous cycle. So this is a quarterly data on business confidence, and there you can see that very high business confidence in the last sort of positive commodity cycle. And you can see over the last couple of months, we have started seeing that business confidence number pick up. And I think as long as we stay on that positive trajectory, and there are no major local own goals in the government of national unity, that confidence will pick up. And I think part of it will be the improving SOEs, and part of it will be our rate cycle. So in terms of our expectations right now, we're not 100% confident on a sustained risk on appetite globally. What we're seeing in the US is growth is slowing a little bit. We've got very high valuations there. China's been going through a very difficult cycle. They have most recently started stimulating more than they have in the past, and long may that last. We are fairly confident of a resumption of emerging market versus developed market performance, and we've got a chart just now showing SA versus developed market. We're more confident in improvement in SOEs. The public-private partnerships are starting to really mature. We see continued recovery in electricity generation, and that likelihood of rate cuts. In terms of the Fed, this has changed a little bit. We were looking at 175 basis points of cutting between now and a year ahead. We were expecting, or the market was expecting, 75 basis points before the end of the year. With Friday's data, that's probably dropped down to about 50 basis points. But nevertheless, real rates are very high, and we expect those to start coming down. And talking about that economic growth, if you look at that US number at the top, slowing from 2.5 to 1.7. Europe, pretty much anemic growth, a little bit of growth coming out of Japan. China, slowing, but pretty solid numbers. And South Africa starting to pick up. But what we see right at the bottom there, if you look at the second and third line from the bottom, you've got developed market growth slowing down there, and a very strong pickup from EM. And that chart on the right just shows you your 5-year rolling returns of South Africa over DM. And SA is a great proxy for EM. And you can see how that is starting to change. And hopefully we've gone through a period of prolonged underperformance for SA and EM, and we could well be coming out that, particularly if we manage to improve the SA situation and we find a bottom in China. And then just that SOE data we spoke about, this is an index created by Chris and Ossa, and it's effectively our energy availability, our port and our rail tonnages. And you can see that very nice improving trajectory from the start of last year. Eskom also, we all know, it's been a long period of no load shedding. Eskom availability factors are almost the highest it's been in ages, and it's not because of planned outages, because you can see that the planned outages are the highest they've been. So it's the maintenance hasn't stopped. They've continued the maintenance, and they've kept the lights on. In terms of the likelihood of rate cuts, we see inflation actually dropping below 3% in October. Potentially, and then picking up slightly from there. But we certainly believe the SARB has ample room to cut, and we are saying the market is saying around 120 basis points of cuts over the next 12 months, which should be very beneficial in terms of easing the tough situation consumers are in, and anyone with a slightly leveraged balance sheet. In terms of our portfolio positioning, we've got just over a third in large cap, the rest is in mid and small cap. And you can see that somewhat represented in our top 10 holdings, a number of mid and small caps there, pretty SA Inc. focused, Nampak, Roynet, Hoskins, Cal or Carp Agri Group, Mr. Price, Pan African Resources, and SA Gold Plan, Stadio, some of our top picks in that. We're just going to run through three companies, three of our preferred picks, just on that view that China may be a bottom on that view of strong demand for commodity green metals, especially for energy transition. We've done a bit of work on Anglos, well, Campbell Parry, our resource analyst, has. And what we like about Anglos at the moment, what we've done is shown two scenarios, the current sum of the parts 590, and then where we look at through the cycle multiples for some of the unlisted businesses, plus the current valuations of Kumba. You can see they're the same price, and Amplas, which they get unbundled. We get to around 730 Rand of value. That copper asset is terrific. There's a lot more room for phase two there. Many of their peers want that copper asset. They know they've got to work fast to unlock value. BHP could certainly come back in mid-2025. So while we've got that potential for that pickup in the cycle for commodities, we've also got a lot of corporate activity potential in this candidate. I'm going to hand over to Pete for the last two. Thank you.
Thanks, Barry. So on the next two slides, we'll just talk to two of our mid-cap opportunities. The first one is Hoskin Consolidated Investments, HCI, which is an investment holding company. It has interests in both JSE listed companies as well as a number of unlisted companies. Its major listed company holdings are Tsogo Sun Gaming and Southern Sun Hotels, both of which account for just under 40% of their portfolio, with other controlling interests in Frontier Transport Holdings, which is a bit of a cash cow, and they're certainly not afraid to pay out a special dividend, eMedia and Deneb. Their major unlisted investments are their 50% stake in Impact Oil and Gas, HCI Coal, and HCI Properties. So interestingly, at the moment, their listed investments only make up around 190 Rand per HCI share, which is higher than the current share price of around 175 Rand a share. So the really interesting part, though, for us of the HCI investment case is the optionality that the oil and gas business brings to the table. We've tracked what the market implied value of the oil asset is over time since the early 2020s, as you'll see on this chart on the right. And the market is now placing a negative value on this asset for the first time in 2 years. And one would argue that there's more certainty around possible value than there was 2 years ago, particularly given the recent transaction or the reference price around the recent Africa Oil transaction where they upped their stake. That would value the asset at closer to 7 billion Rand, which ironically is where we had the market valuing it in mid-2023. There's been significant de-gearing, both at the underlying subsidiary level, so at the gaming and the hotels, as well as at the HCI holding company level. And that's since COVID. Obviously, this business was deeply affected by the COVID shock, but has come through that very strongly over the last couple of years, and we believe has de-risked the business substantially. It's also opened up a number of options for Johnny going forward, of unlocking value through corporate activity, and I wouldn't bet against it, for further potential transactions down the line. At a 40% discount to some of the parts, using a relatively conservative value on the oil, HCI is probably going to be in our top holdings for a while to come. And then just on the next slide, Barry. So the other one I wanted to just touch on was Nampak. Many of you will know this is a packaging group with a focus on beverage and food cans. 2023 was a watershed year for the company. It was at a crossroad. It was in desperate need for a change in direction. And while turnaround stories don't always have fairy tale endings, the reason why we liked the Nampak turnaround was due to the people involved and who were invested in doing it right the first time. So, this was a good example of collaborative engagement with management and other stakeholders, which ultimately resulted in a significantly improved outcome here, and led to the company successfully completing a rights offer, renegotiating their debt terms with the banks, and delivering a clear and concise turnaround strategy under the stewardship of new world-class management and as well as their board, actually, that was incentivized the right way. We also, as previously mentioned, the ownership interests would make them very much aligned with us as investors. So, to sum up, what Phil Roux and his team have managed to achieve in the last year has exceeded our expectations by quite a big margin, and they've de-risked this business substantially as well. We still like Nampak, even after its 140% gain over the last year, given that they're only 1 year into their turnaround, and the business only trades on a forward 6.5 times multiple in our numbers. And we believe there will be significant further deleveraging over the course of the next 3 years. So that's another one we really like. And I think that ends off the presentation. Thank you very much to BCI for hosting us, and appreciate your time.
Peter and Barry, very insightful indeed, and phenomenal fund. If I look at the numbers, and maybe we can start there, Peter. I mean, you showed a very interesting slide with your up and down capture ratios, and we can see it in your returns as well. The up capture ratio is really working. What I do find very interesting, your down capture ratio is sitting below 60%. How do you manage to do that in the fund?
So, as mentioned, Eugene, we do sometimes use cash as a protection mechanism. I think, an example of that would have been during the early stages of COVID in March 2020, where the fund actually went to close to 20% in cash, which is kind of our limit. And we managed to protect capital there quite substantially. We've done maybe not to that extent, over the next few years, but we've certainly used that as a tool to protect capital, where there's significant volatility and the market's very overbought. We're very active traders within this fund, and opportunistic in terms of protecting capital where we deem it necessary. I don't know if you want to add to that, Barry.
No, that's spot on. Thanks.
Barry, you spoke to the SA growth story, and if you listen to the Government of National Unity, it almost seems like 4 years back, where the government's targeting growth of 3.3%, if I remember the number correctly. Certainly also showed, the disparity between developing markets and developed markets in terms of projected growth going forward. How important is SA's future or growth or potential growth, or how closely is that linked to what's happening in developed markets? Do we not need a lot of foreign investment to achieve those kind of growth levels, or where is it going to come from?
I think, when there's a crisis in developed markets, it's very difficult for us to outperform. But I think if we look back at a period like the early 2000s, where you had just exited that NASDAQ bubble, and you had a strong growth driver coming from China, you had emerging markets able to outperform substantially. And a lot of capital that's currently invested in that MAG 7 in the S&P 500 started, well, it wasn't the MAG 7 back then, it was just the internet sort of bubble. And look, I do certainly agree that the fundamentals of the AI companies are a lot more a lot less exaggerated than they were back then. But nevertheless, there is still quite a big valuation disparity between the S&P and developing markets. And I do think we do face that potential condition again, particularly if we do see China starting to improve. I think the point we wanted to make in our slides, though, is that even if China doesn't materially improve, just the work we can do with SA business confidence improving, we can grow. Maybe it won't be 3.5%, maybe it'll be 2%, and that will still be quite meaningful for a country that's been sputtering along at maybe 1% for the past 5 years plus.
And there's definitely some green shoots among SA CEOs. So business confidence is definitely improving. Sydney, if I can maybe come to you very quickly on the Enhanced Income Fund. You're very positive on SA bonds, but how does that play out in the Enhanced Income Fund? Did you significantly up your duration, or is there still some risks out there that you need to think of?
Okay. Thanks, Eugene. Yes, we are positive on local bonds. But speaking about the Enhanced Income Fund in particular, the biggest component of the Enhanced Income Fund is to use credit within that fund. So that effectively is making use of instruments such as floating rate notes, where the spread above JIBAR is what is being targeted in order to get your stability within the fund. So the fund is really, I name it an icebreaker. It's really something that sets its eye on its goal and effectively uses that spreads to achieve its goal. We do use bonds within it because we need to remain competitive within that space as well. And to answer your question, have we upweighted our bond exposure or have we increased duration? Yes, we have, but it still remains a lesser component of the fund. At the moment, we're just over 10% in nominal bonds. We do the biggest asset exposure is in floating rate notes. It's between 70 and 80%. We've got a small exposure to inflation-linked bonds as well, because I do think even though inflation-linked bonds are connected directly to your real yields, they do have a place within the investment spread within the fund. I think every home should have at least one, but the bond component is really there to take advantage of the position we are in at the moment in terms of the interest rate cycle. And if interest rates are going to be dropping as we anticipate, barring all the things we spoke about this morning, not only myself, but my colleagues out there as well, we should see a capital appreciation. So we at the moment, we're at about 10%, max will probably be 15%, and we'll take opportunities as we go along. Thanks, Eugene.
But certainly inflation-linked bonds, I'm still trying to get my head around it. Because you would think, a year ago when inflation was ticking up sharply, and here before that, you would do well in inflation-linked bonds, and are disappointed tremendously. When is the right time to actually get more into inflation-linked bonds?
Yeah, I think that's the million rand question or dollar question. It's a difficult one. I think there's a place within portfolios to have them. You should have them because that provides a hedge, a long-term hedge against inflation. You shouldn't be buying them for short-term gain. Secondly, I think inflation bonds are a separate asset class altogether. They're not nominal bonds. They are not equities, even though they're called bonds, and they do have a predictive or a relatively predictive repetitive income stream. It's linked directly to inflation, so a separate asset class altogether. Unfortunately, I think in our local context, the inflation in bonds is a bit anomalous in the sense that we do not have a very liquid market. And I don't think these instruments are very well understood. So they are traded relative to nominal bonds, which shouldn't really be the case. You should be trading them or buying them for the inflation edge or to take advantage of real yield. So most certainly, I think it was the right time to get involved a little while back to take advantage of the real yields. But unfortunately, we've got a situation where they're being traded anomalously at the moment in our market. And until that changes, until we get enough liquidity, then we'll see normality in that market. And then you can trade them based on their theoretical and practical value. But most certainly, I'm still a proponent, and I think every home should have at least one.
So I must commend you on the way you've managed the fund for many years already, the high level of consistency in your fund. It really, really stands out. Very last question, Barry and Peter. We're getting this a lot from clients as well. With US elections around the corner, a lot of speculation whether a red or a blue win will impact or have a negative or positive impact on SA equity specifically. Your views on that? Does it matter? Does it not matter?
Like I said, I think it certainly will matter to some extent, and I think a blue might be slightly better for South Africa. I think Trump's policies can be a little bit disadvantageous for us, but nevertheless, I think we've got enough opportunity, self-help opportunity in South Africa that whatever the outcome is, we should be able to grow certainly above what we experienced in the past decade.
I think that's a very important answer for investors. So don't watch too much Sky News or Fox News, right? Stay away from that. Gentlemen, it's unfortunately all we have time for this morning. Very insightful presentations indeed, as always. To our audience out there, the Investec BCI Dynamic Equity Fund on most of the large platforms. If you need to get more information, we'll get you in touch with the Investec team, Barry and Peter. Ebeth on the back as well, doing distribution. Certainly, we know you extremely well, the Cadiz BCI Enhanced Yield Fund and all the platforms. We know the fund very well. It's there to be used, most definitely. To our audience out there, quick reminder, next week, Wednesday, the 16th of October, can you believe it, halfway through the month already, we'll have another discussion on where we are going with Hollard and their views on the market. Barry, Peter, Sydney, thank you so much for your time this morning. It's been really great having you on again, and we'll chat in the near future again. Thank you very much.